right. I want to thank everyone for joining us as we head into the holiday season and the end of the year. I know what's first and foremost on everyone's mind is taxes. So I want to thank everyone for joining us. I want to thank everyone for joining us while we go over some good year-end planning that you can do, some topics to discuss, and make the most out of the end of your year. By way of introduction, we have Blake, Will, and myself running the webinar, and Catherine's behind the scenes here by the Christmas tree. She'll be fielding your questions. If you have any questions, Catherine, what's the best way for them to ask?
If you have any questions, you can either send me a chat directly and I will get it answered, or you can click on the Q&A button at the bottom of your screen and send a question. Questions are what make the webinar the most lively and also the most helpful. So please send as many as you have. Happy to get those answered.
Yes,
I agree. We love questions. Jordan and I can talk taxes for the next hour if we need to. We'd much rather answer questions while talking taxes for the next 30, 45 minutes, something like that.
yeah, absolutely. So a little bit about today's agenda will be kind of split into two segments. The first, we'll be going over things that impact individuals, such as charitable giving towards the end of the year, gifting to family and friends, how to use 529 plan contributions. Topics that are becoming more and more relevant in 2022 is harvesting capital losses. And then lastly, we'll be talking about estimates. The next section is geared specifically towards small business owners or financial advisors who have small business owners, some potential topics that you guys can discuss here at the end of the year as well. So that'll be year-end purchases, how that again can impact your taxes, depreciation, some changes that are going on in 2023, retirement accounts, and then finally, what we recommend you do with these last few weeks in terms of reflection and planning on your year for the upcoming year. Next. Perfect. So individuals, whenever we're talking about charitable contributions, there's a couple different ways that you can donate, both cash and non-cash. What that means, cash does not mean I have to give a $1 bill. You can also write a check for anyone that doesn't know that. And then non-cash, it can be a variety of different items. You can donate appreciated securities. You can donate your old couch. You can donate a car. So lots of different things that you can contribute to charities here towards the end of the year. There are different limitations in terms of what you can deduct in comparison to your overall income. So the last 2 years, we've been working with 100% cash charitable contribution limit. That means that basically, if you made $100,000, you could then donate $100,000 to charity, and then you could write off that entire amount. It's switching back to 60%. So that means if you make $100,000 and you donate $100,000, you'll be limited to a $60,000 charitable contribution.
I was actually emailing with a client yesterday. She's giving a lot of cash, some stock, some securities, but also some actually depreciated paintings.
Oh.
And there's different limits, the 60%, 50%, 30%. And it's important if you're trying to maximize, it's not all of those limits added together, first
Correct.
of all, to go over 100%, but it goes in almost reverse order, highest to lowest. So in Jordan's example, if you gave away 100,000 of cash and you made 100, and also stock of 30,000 in a year, that 30,000 stock would not be deducted at all. It'd be carried forward. You would still deduct the 60 of cash with a 40 carry forward there. So you don't use the lower limits first. So that's important when you're doing, especially big charitable gifting, to talk to us about, this is how I should do it, to make sure you're maximizing it, maximizing your deductions. Absolutely.
Planning on where you're going to pull those funds in order to facilitate your charitable endeavors is very important, especially if you're donating large amounts. If you're going to donate $100 to the Make-A-Wish Foundation, you can probably just do that without a conversation with us.
Probably could.
Some items that are pretty common in terms of questions that I get of, does this qualify for deduction? If I go work at a soup kitchen, I do not get to write off my time as a CPA at my hourly rate at that soup kitchen. That's simply not how it works. So if the IRS does not view the donation of your time as something that should impact your taxes.
I always tell people the thought is, well, you didn't work that time as a CPA, so you didn't get the income. So you're in essence are deducting it. If you just lost the income, you never were taxed on it before. You would have had to say, well, I'm going to make up this income that I would have made to then deduct it, still getting you to the same answer.
Yeah.
Still a good question, but it doesn't work.
Yeah. And then auction items, So a lot of people will go to some sort of charity event where, you know, a case of wine will be up for auction. If you put in bids on that, and let's say the box of wine is worth $14, if you're at the auctions I'm at.
Yes,
Um,
yes.
So if you donate, if you bid $10, there's no tax deduction in that case. If I were to bid $500 and I receive that box of wine, I'm going to get about $490 of a deduction in that
For
instance.
sure. It's the extra over the fair market value that you paid. And also you don't get it for if you lose the bid and say, well, that was a donation. No, it was a gamble to win the
Yes.
thing.
And then lastly, GoFundMe's, which have become popular in social media. While they certainly can have a charitable intent, the IRS does not allow those donations as a charitable deduction. It's not a public charity or a private foundation in most instances. Most of the time, it's just a family that needs money for medical expenses, something along those lines. So while it is certainly beneficial to society as a whole, it is not a tax deduction.
Correct.
And then let's talk a little bit about towards the end of the year, what is the avenues of donation that we have? So you can obviously donate money directly to a charity. That means write a check directly to the Make-A-Wish Foundation, donate stock directly to whatever foundation. There's also some other funds that are available whenever you have increases in income that you're wanting to dramatically offset, or if you're wanting to combine in estate planning along with charitable giving. Those are fairly nuanced to go in and describe. I will say that they are options. If you have a large spike in income and you want to talk about doing large charitable endeavors towards the end of the year, I recommend you call in and make an appointment with us. I'm happy to walk through it. But there's normally more nuance there than we can go over in a webinar. And then the last thing to consider is state credit options that are available whenever you donate to charity. So Lydia's House is a good example. I believe it's a 70% credit that you get on your charitable donation. So if I donate $1,000, I get a $700 Missouri state tax credit. That's a direct offset to my tax liability. If I don't use the entirety of it, it carries forward for years. But the other side of that equation is if you get that deduction, or that credit is really what it's called, that credit on your state tax return, it's an offset to your federal tax return. So if I get that $700 credit, whenever I'm reporting my charitable contributions, I need to net that credit against my overall tax liability. I don't expect anyone on this call to do that. If you provide us the documentation, we will do it.
We know what to do, but it is something, if you think I'm getting a $700 credit and then I'm also going to deduct $1,000, you could do the math and say, well, am I actually making money by donating? And it just doesn't work that way. And we have clients all over the country. There's various, Arizona has some great credits. There's different states have different rules. So if your state is a little different, you want to talk to us about potential state tax credits, give us a call. This is a great way. And you're going to pay the state taxes anyway. So it's just a way to tell the state, hey, support Lydia's House because I like that charity. So it's a good way to kind of direct where your dollars go.
Great. Any questions, Catherine?
No questions right now, but like I said, if you would like to submit one, please feel free to send me a chat or use the Q&A button on the bottom of your screen, and very happy to get those answered.
Great. Next, let's talk about a different style of gifting, maybe one without a charitable intent, where we're trying to pass money to a friend, to a family member, grandchild, etc. So we're talking about giving cash in order to support them in some fashion or just benefit them in some fashion. Number one is that contribution of cash to an individual a deduction. It is definitely not, just to make that very clear. What it is it goes against your annual gift allowance. So every year, Blake, for example, can give $16,000
To Jordan.
to me. And it has no impact on his overall lifetime exemption of $12 million. His wife, Julie, can also give me $16,000. In this instance, I pay no gift taxes. Blake has no filing requirements with the IRS because it's under the annual exemption. If Blake decides to get very generous and give me $100,000, and so does Julie next year, then $200,000 will then be used as a gift, and it's $168,000 will go against his lifetime exemption, bringing it down from 12 million down to $11.9 million.
That's correct.
The current lifetime exemption of $12 million is the highest it's ever been. It's not sunsetting for a couple years, but it's a common question I get towards the end of the year of what kind of money can I give away? What are the tax consequences? Normally, the answer is going to be none, but once again, it's situational dependent. It depends on the amount that you want to give. So if you're thinking about giving large amounts of money away, certainly give us a call. We're happy to talk through it with you.
And some people too, as they're gifting to their kids and grandkids, they might say, well, I give them 16 grand this year. Then also they need 2 grand here and there for car payments, stuff like that. Technically that's over 16,000, even though it's not, is it a gift? Yes, it's a gift. Sometimes with the marriage, you can get under the stuff, but then we want to talk through it, make sure you're comfortable with your gift tax return filing requirements. At the end of the day, we can file a gift tax return for you. Not a huge deal. It uses that $12 million exemption per person. That is going to change in 2025 unless they extend it. Could go to 5 or 6 million.
Yep.
And talked about going to 3.5 or 1. There's all, who knows what it's going to actually go to. Probably be something less than 12 at that point. For a lot of people, 12 each, plenty. 6 each, plenty. So if you had to do a gift return, it's not a giant deal.
Yeah.
Just let us know.
And also, it's not just cash. So let's say you buy them a Christmas gift and you've given them 16,000. Technically, once again, that is reportable. Technically.
Yeah.
And lastly, a different style of gifting is funding a 529 plan, which is a state-sponsored education plan. There's an option to what's called super fund it, which is essentially take 5 years worth of contributions, pile them all into the current year. It doesn't impact that current $16,000 limit or your lifetime exemption when you do that. There is a reporting requirement. The benefit of that is 529 plans have a tax-free growth in them. You start that growth earlier. There is some downside to it in terms of it creates additional reporting requirements with the IRS. And also you're going to lose on the deduction that you get in most states on an annual basis whenever you super fund it, because it's going to exceed the annual limit.
Definitely something to discuss. Like if you're looking at super funding or just funding 529s in general, give us a call.
Yep.
We'll talk through it.
Any questions, Catherine?
Currently, we have no questions.
All right. Harvesting capital losses is a topic of conversation that's come up more frequently in the last 6 months than I'd say the last 10 years of my career combined.
So me too.
So what I always like to make clear to people is that you should be consulting with your financial advisor on this first and foremost. I can explain the tax laws and losses to you. However, your financial advisor is in charge of your overall investment strategy. Those strategies normally span out 3, 5, 7, however many years, far extending the time of a recession or anything along those lines. So certainly they are your primary source of information. That being said, here are the tax rules to it. If you decide to sell one of your stocks at a loss, which means I bought it at $100 and I sold it at 70, you're allowed to take a capital loss on that. If you do that with many stocks and overall your losses exceed your gains for the year by more than $3,000, you'll get capped at a $3,000 overall net loss position that you get to deduct. Any losses in excess of that $3,000 carry forward to offset future gains and future rules. The main thing that you want to watch out for when you're doing this is participating in wash sales, which is essentially if I buy and sell a security within a 30-day window, any loss that I incurred on the sale of that security is ignored by IRS purposes.
I want to repeat the 3,000 net loss again. That's if you go net. So if you've 100,000 in gains, 150 in losses, you go 50,000 net loss. You only use 3 of that net loss this year. 47 would go next year, and you won't lose. It'll keep going. And if you have gains next year, it'll offset that. And yes, the wash sale rule is a big deal, and that's before and after the sale. You can't have bought or sold it. For some securities, if you sell it, wait 31 days, buy it back, no worries. It fits in with your investment. Some people are like, no, that 31 days could be a big deal for this. Maybe it's a little bit of a volatile stock. Now, who knows what's going to happen in that 31 days? I don't want to miss out on that upside. You got to talk to your financial advisor about maybe other investments that are similar enough. They can't be too similar or else they still qualify for wash sale. But if you go, somewhat in the same industry, things like that, it could get you a little bit of your upside risk minimized.
Could you comment on violation of wash sale rules within mutual funds and EFTs?
Yes, I can
ETFs.
at ETFs. At the end of the day, we are going to go off what the 1099 says from the brokerage firm. I'm not going to look and see, well, if this was a sale here and this was a loss here. Are those similar? I won't know what you bought in essence either. It is up to usually the brokerage firm, whoever it is, Merrill Lynch, Edward Jones, is going to have it on the 1099 if this is a wash sale.
Yes.
And that's what we would go off of. If they're similar, again, that's not up to us to decide. But it's equal or substantially equal, I believe, is what the tax law says. And if it's the exact same mutual fund, just with a different name, you could argue that as a wash sale. And I don't want to go much deeper than that because I just don't know how the different places do that.
Yeah.
But we go off of the 1099.
Are investment losses only offset by invest sale gains, or can it be offset by income?
That's the 3,000 net loss overall goes against ordinary income.
Yep.
First goes after gains, second goes after takes away ordinary income.
And the capital losses, short-term versus long-term, they will offset each other. So even though short-term is taxed at ordinary income rates, a long-term loss can still offset it.
Yeah, so they each take out each other's gains first, then together, then can go net 3,000 over against ordinary income.
Yes.
Excellent.
Great questions.
Yeah.
Love it.
Thank you. Keep them coming.
Great. Lastly, one thing to hit on is lots of clients get a little bit antsy as we get closer to the end of the year. They're wanting to know what their overall tax liability is. Just a quick reminder of two common ways of determining tax liability or dealing with the tax liabilities. Number one, the safe harbor rule. If you're paying 110% of last year's taxes, regardless of how underpaid you are, you'll have no estimated tax penalties. The other side of safe harbor, which is the calculated estimate side, is if you've paid at least 90% of your current year liability before the end of the year, once again, you'll have no estimated tax payment penalties.
Sometimes it's very easy to do 90% of current. I just had a meeting with a client. He has a lot of tech partnership investments and things that we don't necessarily know till March, April, what that is.
Mm-hmm.
So we're trying, and we don't want to do 110% of last year because capital gains were high then. So we're doing our best to hit 90%. If you hit 88% or 82%, you will have an estimated tax payment penalty. As long as you're somewhat close, it should not be significant.
Yes.
Again, it's still a penalty. We try to get out of as many penalties as we can. But at some point we want to try to get as close as possible. And we shouldn't just pay a lot of extra money and have the government sitting on an interest-free loan. Sometimes it might be better. I think it's this. I'll keep that money in cash, actually earn maybe $1 or $2 with today's interest rates, pay a little bit of a penalty until we know for sure what that tax liability is, especially for a business owner. Sometimes it's hard to know where I'm going to end up, even if you're in January or early February. It's going to take till March, April to have a better idea with finalizing your books. So definitely give us a call to discuss that.
Yep, absolutely. Any other questions, Catherine?
No other questions right now.
Great. So this next section is geared specifically towards business owners. Once again, if you are a financial advisor on this call and you have business owners, feel free to discuss any of this information with them. They're great conversation points. If you'd like for myself or Blake to jump in on one of these calls, we'd be happy to get something on the calendar with you guys.
Even if they're not a client.
Even if they're not a client, for sure. All right, so year-end purchases, why is it even a thing for a lot of people? I guess is the first question. So the first things that I like to run by them is, number one, it is a tax deduction, but how much does it really benefit you at the end of the day? If I've run a business and maybe I've had a rough year, is it really worth my time and effort and cash to put something into an investment that I don't necessarily need just because I'll get rid of substantially all my taxes at that point? So the first question that every business owner needs to ask themselves about these year-end purchases is this something the business really needs? Is it going to help me grow my business, or am I spending $60,000 to get a $30,000 benefit? And at the end of the day, I'm not really going to walk away with that much personal benefit out of it. So certainly something to consider. Tax deductions, it depends on, once again, the operations of your business. So evaluate how you've performed, talk to your CPA, determine what's the overall benefit to this write-off? Is it something I want to spend my capital on? So common write-offs that you're going to see at the end of the year are normally vehicle purchases and equipment purchases. One thing that I like to make very evident to clients is the IRS rules on the purchase of a capital asset are based off the date placed in service. So as of right now, a big issue is that there's a delay in actual receipt of trucks, vehicles that you purchase. The IRS rule is that it is not available to deduct until it's available for you to use. So until it's delivered, essentially.
Which is different than most things. It's just, if I spent the money,
Yes.
I deduct it. It's different on this sort of thing for this exact reason, trying to front load something that isn't going to come in for 8-9 months. That's a deduction the next year. I want to go back to the business need too. I mean, it's something people ask all the time. You know, it's if you're going to buy the thing and it's going to create new business for you, new opportunities, and it might be a little tight on cash. I need it now. Plus I get the tax deduction. Okay, there's 3 or 4 things to discuss. Let's go for it. Like, I don't really need it for a year. It's going to be tight. And maybe you're in a lower tax bracket now than you will be then as your business is on an upward trajectory. Probably better to wait than to buy it now. But again, definitely worth the discussion.
Yep. Some other options that aren't necessarily, these fixed asset purchases, but other way to expend capital towards the end of the year that can benefit you in terms of your overall tax liability. This is specifically, I want to make this very clear, geared towards cash basis taxpayers, which is a majority of taxpayers that we work with. The difference between a cash and an accrual basis taxpayer, I think of it this way. A cash basis taxpayer is going to pay taxes based off the cash they receive. An accrual basis will be based off of the invoices they send out.
And the flip side is the cash they pay or the invoices, that the bills that they have on their books.
Correct.
So accrual basis, you don't have to have received any money. If you invoiced them, or you could have invoiced them, it's income. Same thing with payables. You don't have to have paid the vendor yet. It's still a deduction. Cash basis is the opposite. The money has to have left or come in.
Yep. So some methods that you can do to decrease your overall tax liability are increasing your inventory, whether that be actual physical inventory or, a pretty common one is with farmers, I'd say, where they're pre-purchasing chemical or seed at the end of the year that they're actually going to end up using next year. So those are certainly options to where you can accelerate the deductions into the current year. Paying down of payables as a cash basis taxpayer, once again, wonderful way to do it. So it's something you're going to have to pay regardless. If you have the cash flow, you have high taxes, you don't really know what to do with all your cash right now, that's certainly an option. And then lastly, delay the receipt of your payments. This, just to make it very clear, doesn't mean if you receive a check, you stick it in a drawer and ignore it. It may be working out a payment, a net 30 versus a net 60 with an ongoing client. So something along those lines.
Yeah. If all you have to do is cash the check or say, hey, send me the money, you got the money. It doesn't work that way. The other thing I want to mention too, these things it's kind of a 1 year, it's just 1 year. Like if you buy inventory now, or again, the farmer's the perfect example, prepay your fertilizer, your seed. Well, the next year you're going to have 0 seed, or you have to do it every year, which is fine. So it's a 1 year delay until the end of time, whenever you no longer have to do it, if you stop farming or stop being in business. That's something that's sometimes a little short-sighted, or if I'm in a lower tax bracket now, or think can be higher later, maybe skipping a year, pay the taxes now, maybe double up next year if we think tax rates are going up because of your income or something like that.
Yep, absolutely.
Doing on time. Doing good.
Doing good. So one thing that a lot of people may not know is what's the actual methodology for how these things are written off. They know that they're being written off. They don't necessarily know the ins and outs of it. So there's 2 ways that capital purchases are written off primarily. One's over time. It's called modified accelerated cost recovery system. Didn't even have to look that up again before the webinar. And then the other method is straight line. Straight line is exactly what it sounds like. If I buy an asset and it has a 15-year useful life, I'm going to depreciate 1/15 of it each year. Macros is it's more heavily weighted toward you have a larger deduction in the beginning years.
Either way, that's what depreciation is usually, is the overtime. You're slowly depreciating it over time.
The other method of depreciating something is immediately. So that is the bonus depreciation in section 179 depreciation. How did I do that? Bonus depreciation or section 179 depreciation. That essentially means you're going to expense it, write it off against your income in the current period. In the last couple of years, bonus depreciation and section 179 have been pretty well interchangeable. Bonus is a little bit better currently in terms of just overall limitations, but at the end of the day, pretty interchangeable. Not a lot of people using section 179. One thing to keep an eye out for is in 2023, bonus depreciation is decreasing to 80% of the asset value, and then that remainder 20% will have to be depreciated over time. Section 179 still exists. I forget the current limitation, but it's very high to where it's
over $1 million, I believe.
most people don't need to worry about it. So you'll still be able to write off things directly. Once again, the question is at the end of the day, is that really what I want to do? So I'd say almost a reverse of the example we have been giving let's say that my business hasn't had a great year, but I really need an asset in order to open up a new sector. And I think that I'm going to start making a lot more money in the future. I may want to use the straight line or the Macker's method of depreciating that asset rather than writing off the entirety of it this year against little to no income. So if you have large capital expenditures that are upcoming at the end of the year, want to talk about how they impact your taxes, once again, feel free to set an appointment with us. We're happy to walk through it with you.
For sure. I mean, it sounds great. I'm going to buy it. I'm going to write it off. Great. Sometimes that is the way to go. Let's say you're in the 24% bracket. I buy something for 100,000, saves me 24 grand today. If I think I'm going to be in the 40% bracket over the next 4 years, well, I'll make 16,000 more if I wait. 24 now might be better, for you, or 40 over time might be better. So it's worth having that conversation. Last thing I throw out too on that, sometimes states have different rules. Like California is a big one that does not recognize bonus depreciation, the high tax rate. So sometimes that's a little bit of difference where I thought I was getting the 50, you're only getting the 37% deduction for the feds, and you'll get the rest over time for state purposes.
Yep. Any questions, Catherine?
We don't have any questions right now.
Okay. So one thing that we wanted to talk about going into the end of the year is retirement accounts. My main goal with this slide is just to make people informed that there are retirement options that are available to them. There are a lot more than are currently listed on this slide. The decision on which one you should choose is nuanced based off of your income you produce, the number of salaries you have, the amount of administrative costs you want to burden. So there's a lot that can really go into this.
Type of employees.
So what I want to just give you a brief overview are some of the more basic plans, more common plans, and then, kind of what you can do to move forward. So the first one is a SEP. It's one of the most basic ones. Not a lot of administrative hassle to set it up. You can set it up in a relatively short amount of time. I'm fairly certain you could set it up before the end of this year, depending on who you're with, but almost certain on that. Lastly, there's 401ks. It's one of the most common plans. Those are typically available to people who have a number of employees. You can tack some things onto them, such as profit sharing agreements, so that employees can participate in the overall growth and profit of the firm. It can be an incentive to keep people with you. Another option, if you just I am in deduction mode, I have all the cash that I need, so let's find it. That's a defined benefit plan, essentially setting up a defined amount of money that you're going to get paid on a yearly basis in retirement. This plan requires actuaries to get involved. It is the most administratively expensive plan to administer, but it is certainly a good option for some people. I don't see a lot of them, but for some people, it's perfect.
Especially when you're towards maybe the end of your high earning years.
Yes.
I can, accelerate a big deduction and then maybe take some out over lower tax years. And it's the defined benefits. It's the opposite of a 401k, which is a defined contribution. You can put in 20 grand, 22,000. Defined benefit is I need 50 grand in 50 years. So how much do I have to put in now for it to grow? That's why it's actuaries and plan administrators that have bigger fees and things like that, but it could be more beneficial.
Yes, sure. Exactly. The last one is an individual retirement account. It is a wonderful tool for the right person. I will say that I have a decent amount of business owners that is their only retirement plan that they have. There are other ones available to you is what I'm trying to make clear. It's worth a conversation with us, with your financial advisor about what works best for you.
I want to go back to SEP real quick too.
Yeah.
That one, that could be for maybe you have a side business and you have some self-employment earnings there. Your spouse has a side business making 20, 30 grand there. You set up a SEP now, next year, you can put in 20% of the net income there up until when you file the tax return, which could be October.
Yes.
There's a lot of flexibility there, relatively cheap to set up. So if that's something you want to, let's go ahead and get it set up, even if we're not sure. Well, maybe the business just started. How much money are they going to make in the upfront? Let's go ahead and get it going. So then the options there, whenever we're finishing the tax return, rather than, well, you could have set this up there. So I believe you have to set it up in the year of. It's possible you don't. There's all kinds of different rules on when they need to be set up.
Yeah.
But it'd be important to just talk through it. Even if it's 4 or 5 grand here, there could be a nice retirement plan for, again, a side business or for the spouse that might not have a W-2.
Right. And even if the answer is, oh, I can't set up my 401k this late in the year, it'd be great to have it next year, I bet still.
For sure.
So
Agreed.
worth having a conversation about.
Agreed.
The last thing to kind of wrap up here is just good housekeeping in terms of what a business should do towards the end of the year, which is compare the actual results of your business versus the overall budget or expectations that you had. Did you get where you thought you'd be? If so, great. How can you do it more? If not, what do we need to change? Asking those simple questions of working on versus in the business are especially important at the end of the year. It's kind of a milestone point and creates a good opportunity for a self-evaluation. It's also a good opportunity to talk about what do you need to do for 2023. If Blake's expanding his lawn mowing business and he needs 3 new lawnmowers, that's fantastic. Does he have the cash requirements to buy 3 new ones? Does he have people to operate those mowers? He doesn't know yet if he hasn't asked those questions. So
Correct.
he could just buy 3 lawnmowers at the end of the year because it's a tax write-off. And there's no real value
My
to it.
7-year-old can't quite mow the lawn yet. One day.
Yes. So anyway, those are important questions to be asking yourself. Do you have the staff availability? Do you have the assets available to expand or maintain your business on the course that you have set for it?
And this is a tough one to do. I mean, everybody's busy.
Yep.
I mean, we're doing all kinds of meetings, pretty much all day. But next week, we have our two-day partner meeting. We're sitting down, each segment of the business doing this is our goal for next year. You have to make the time to do it. It's very important. It's so easy to just roll through the year. Well, it's 2023. Well, now it's June of 23. I didn't even have a budget. Get it done. Call us. We can help. We can talk through and bounce ideas off of whatever it is. It's very important.
Yeah. Catherine, are there any questions to wrap up?
We don't, but I do look forward to you talking through some concrete ways that we can help for those people who may be wondering.
Yes, absolutely. So for people who are considering different retirement plans, we are happy to take those meetings. It's a service we offer of advising on retirement plans, working with financial advisors on what they recommend. We also obviously perform year-end estimate calculations, so people have a good idea of the overall balance that they're expected to owe. That way, going into April 15th, you're no longer nervous, but maybe just ready for what's going to happen. Lastly, we can help you budget and develop your business processes. So if you need someone to just talk through developing a budget for next year, what's the right way to do that? What's some good tips, or just simply having someone hold you accountable to it? Once again, that's a service we offer. And lastly, we're always happy to jump on an advisory call with you and or your FA to talk through any of the points we've listed below.
Any questions, Catherine? Final questions? Last call?
No.
Let's see. I'll just check too, just to be sure. No questions. No questions.
No one asked if the tree was real behind us. I was surprised by that.
No questions. Thanks to everyone for coming.
Appreciate your time. Give us a call. Give us an email. Love to talk to you before year end or next year.
Yeah.
Appreciate it.
Thank you, everyone.